I'm Greg Kidd. I'm the moderator. I'm going to jump right into just introductions from each of our panelists because I think that they're who you're here to see. Just briefly, my background, I've worked in the regulatory community with the Board of Governors of the Federal Reserve and the Payments Group, also with Promontory, and have been on the venture side with startups like Square, Coinbase, Ripple. But today we're here to talk about mobile wallets and mobile money and the future. Let me hand it right over to our panelists.
My name is Bill Gajda, Head of Innovation and Strategic Partnerships at Visa. 6 years with Visa, started as head of Visa Mobile. Before that, I was 15 years in the mobile industry. Now I head up our engagement with the venture community on the way to hopefully a Visa fund, look after Visa Ready, which is our hardware and software certification program, and our innovation labs in New York, Dubai, and Miami, which we're just building out based on the lab that we built in San Francisco.
My name is Alex Davidov. I'm a vice president with Core Innovation Capital. We are a venture capital fund focused on the fintech sector exclusively, and have spent my career across working at a big hedge fund around trading and macroeconomic research, started a couple different businesses in consumer, and have spent a bunch of time consulting to financial services companies as well.
So I'm Derek Webster, founder and CEO of CardFlight. The easiest way to explain what we do is we're like Stripe for the 90% of credit card transactions that still happen in the real world. So provide tools and technology to power mobile point-of-sale applications, card reading hardware, SDKs for app developers, for iOS and Android apps, turnkey apps, and then a payment gateway that works with every major US processor.
So the first construct I'd like to put forth is really a question. This panel has been set up sort of, they always put people in a room trying to create some controversy, and one of the questions we keep coming up with is mobile wallets going to happen? Is this going to be the big year, or is it still going to be cards? Is it still going to be cash? But the first question I want to ask is whether that is the right question to ask. Is it really a question of cards versus mobile wallets, or is that the wrong construct for thinking and defining the issues and opportunities here?
Well, I'm with Visa, so we have a staked interest in cards, so I'll give it a start. I would say that cards and digital wallets are going to coexist for a long, long time. And 2 years ago, I would have said, well, over time, cards are going to be phased out. We're all going to go digital. But I don't even think that's the case now. Visa loves it every time a transaction goes digital. We get about 25% market share when we compete against cash and check, and about 60% market share anytime a transaction goes digital. So I'm all for digital wallets. That being said, plastic works pretty well, particularly here in the US. Because of mobile point of sale, some of the stuff you guys are doing, we're going to go from 40 million places you can use your Visa card today to 80 million in the next 5 years just because of mobile point of sale with good old plastic. And so I'd say that plastic has another good run now because of what's happening in mobile point of sale, particularly in developing markets, and we love digital wallets. So they're both going to do just fine.
Yeah, I think I definitely agree that this is not an either-or sort of decision. I just want to make a couple points here. One is you have to consider that as a venture capitalist, you always start with what's the use case, what's the problem that you're going to solve. And I think for the US, to your point, Bill, we've got really good, very low friction about paying with cards in every single merchant. So one question is just which geography are you talking about? Where are there problems? So if you're talking about emerging economies, maybe that is a place where it's just mobile. Maybe the card plays a smaller role there. Second point I would make is just the fact that we're carrying around these mobile phones with us. It's a computer in our pocket. Everyone knows that. But it really does enable us to do a whole lot of things that we couldn't do before. It's not just a dumb card anymore. You can really customize that transaction experience and do a lot of things. And Greg, you should talk about what you're doing at Shift. Really fascinating stuff that's enabled by the mobile phone. But we do see this as something that both the physical card and the mobile phone will relate to one another and connect to each other to enable new use cases.
Yeah, so I think form factors may change over time. It'll probably be a lot more time than we might realize. If you think about, Visa's really a 50-year-old company at this point in time, and it took really decades to get to the state of ubiquity that card payments are at now. And the fact that you can use it as a consumer basically anywhere you go, the fact that as a cardholder, there's an efficient network there. And so if you are trying to compete with that infrastructure and you have a network that doesn't have that kind of widespread acceptance, that really weakens the value proposition for consumers or for merchants to accept it. And so I think, form factors may change. Mobile wallets, I think there's a lot of interesting things happening there, but I do think that the role that the payment brands, the Visas and MasterCards and American Expresses and Discovers are going to play in the ecosystem is really a safe and stable place to be. But the form factors may change, but definitely not overnight.
So in talking about form factors, one thing that has really been the year of, for the last year, has been this issue of tokenization. And the thing that's been curious to me is most people think about, well, is the phone the token? Because the phone is often used as a second form of authentication in many situations. But potentially, I guess, the card itself could be the token. And so let's just talk about tokenization as opposed to cards or wallets and understand where that plays and what that has to do with the revolution that's taking place.
Yeah, let me start by, first of all, there's been tokenization for a long, long time. Your Visa card is really a token of some kind of revolving account or a balance you have in your DDA. The new form of tokenization allows the networks and the merchants and everyone in the ecosystem to think way more flexibly about all these digital wallets. Because as long as you're putting a PAN in an app, your actual account in an app, in the open, on a device, we got really nervous. Right? The minute now I have a master account, which could be my plastic card, and I've got, several tokens tied to it, now we can think much more flexibly about what we'll do with those form factors, including, this is a ring that was used for NFC in London Fashion Week. So it's passive NFC. It's not tokenized yet, but we're going to tokenize it, and we're going to see unbelievable form factors, machine-to-machine, Internet of Things, all the things that are happening in and around the point of sale. They'll all be tokenized. And it's important because if you've got your account in 20 apps on your phone, without a token, if one of those is compromised, everything shuts down. None of those apps work anymore because you've canceled your account. Your bank gets a customer service call, the network hates it, and you're waiting for replacement of your account. If it's a token, we shut it down, we replace the token over the air in 5 minutes, and you're back in business. And none of those other experiences have changed. So I think tokenization has a long run, and we've just started with the pays, Apple Pay, Samsung Pay, and Android Pay.
Yeah, I think tokenization is going to unlock a lot of new capabilities. I think, but there's a certain part of the ecosystem that is absolutely stable, and that's if you think about it. There's 5 parties on any credit card transaction. There's a consumer. There's an issuing bank that actually gave them the card. You've got a card brand like a Visa or MasterCard. You've got the merchant you're trying to pay, and then inevitably there was a bank or someone else that provided them access to the payments ecosystem. And so I think in the future you're always going to still see those parties, but what tokenization allows is a lot of others to come in and create innovative experiences on top of that for some of the reasons Bill outlined, become less secure, less volatile. You can let Google and Samsung both compete for ownership of the consumer's attention on an Android phone, and then simultaneously have the consumer carry their Visa card in their wallet, and then they can choose which form factor they want to pay with. And as long as they go to a merchant that has the capability of receiving that form factor and that has access into the card network to take payments, that transaction can happen. So I think there's going to be a lot of interesting opportunities that are created there.
And I think it's important for this audience of entrepreneurs because I think tokens is going to allow you to think even more broadly, more futuristically about what can happen with payments, because we got really scared every time you came to us with innovation that said, I want to put the pen in this device or I want to do this in an application. With tokens, we're going to have a very different conversation. And so I think it's important for the startup and the developer community in terms of what these tokens mean.
So I'm often on that developer side, and so what looks interesting to us in the old days, identification of the user, authentication, clearing, and settlement all was clumped together. But now, I guess in this world with tokens and whatnot, once you've identified the user, if that user has attached other balances to their identity, and authentication and clearing and settlement could happen, doesn't this create the risk of bypass, i.e. that Visa or other traditional processors may be cut out of the loop and people may just clear and settle direct because they feel comfortable enough about the identification and the authentication that they don't need to go through the rails that have been built up over the last 50 years?
So payments is like one of the most classic B-school case studies on network effects. And there's some massive network effects, and there's some huge lock-in, and so changing that is really tough. There's 50 major merchants that account for about half of all credit card transactions in the US that would like to pay less for accepting those credit card payments. So much so they've started an alternative network to try and disintermediate that. That doesn't mean that there's necessarily a built-in value prop for the consumer to change their behavior. And when they go to an independent restaurant to pay for dinner, they probably can't accept, they can't use that method to pay. So I think there's a lot of people that would like to disintermediate the Visas and MasterCards and Amexes of the world. But the challenge is there's so many other parties that exist that have an incentive for the status quo to stay stable that it's tough to get that ubiquity and widespread adoption. There's definitely use cases where bypassing that route are cheaper, but for the true ubiquitous, kind of volumes we see today, I'm pretty bearish on it.
Yeah, and I think it comes back to what value do you offer the people in the value chain? And so you see things like Klarna in Europe where they're offering a value proposition to both the consumer and the merchant. So for the merchant, that's probably higher conversion, higher average ticket size. For the consumer, that's going to be an easier form of payment, just pay with your email address. And so a lot of those payments are still settled via traditional bank cards or via the traditional payment networks. But it's a way for a new startup to basically insert itself into that process by offering value to both of those parties. And so if you're going to build a startup in that world, think about everyone there that you're trying to, whose behavior are you trying to alter, and make sure that their incentives are aligned with your product.
Yeah, I think that's right. There's a ton of room for innovation around the edge of the networks. What happens at that last mile, new use cases like push payments, person-to-person payments. We've barely explored what happens with commercial payments, which is much bigger than personal consumer expenditure, which is how we think about it at networks today. So tons of innovation at the edge. It's not our technical network or MasterCards or Amexes that is unassailable. It's the ecosystem. It is that network effect. 2 billion cards already there, so really do you want to replace them? They work everywhere. Going to 80 million merchants, 23,000 banks that are already attached, 7 nines, network never goes down. It's really hard to replicate the entire ecosystem, but the edge is going to transform over the next 5 years.
So one thing that's been happening is the regulators have been getting active here in mandating what interchange can be. We have Durbin here in the US, and in Europe, the regulators have come in with caps not just on debit cards, but also on credit cards. I think at 0.3% is the rates that will be going in place later this year. Those are caps on mandatory interchange. But it seems to me with these capabilities around tokenization, merchants could actually, of their own volition, choose to give what might call like voluntary interchange or money back to particular users that sign into particular loyalty programs. And this doesn't have to be tied to a physical card anymore, but potentially a virtual card. And so you could actually get a situation where mandatory interchange is shrinking, but retailers looking at something, what's better than Groupon and the wrist slicing discounts you have to give there. You could do very targeted time of day type of interchange, which is really voluntary. And this might be just the opposite of the kinds of complaints from MCX and those folks that were complaining.
I mean, I think so. Jamba Juice is always willing to offer everyone a free Jamba Juice to try a new payment network, but that doesn't necessarily mean the consumer changes their behavior everywhere they go. And so I think there's huge challenges to making that possible. And I think at the end of the day, would merchants prefer not to pay 2-3% all in for interchange? Yeah. Is cash free? Is it this 2 or 3% versus 0? No. There's definitely a cost of being a large enterprise and handling cash. And so when you actually look at the net differential, it gets really, really small. And at the end of the day, most merchants would rather get paid 97 cents on the dollar than lose that sale, lose that customer, give the customer an experience anything different than how they want to pay. And so merchants, by and large, are going to let consumers pay in whatever method they want. And so the actual real savings that are on the table for a merchant and getting someone to switch to a different method, we're 100 basis points or less really quickly. And if I go spend $100 on dinner with my wife and I'm offered 50 cents to download an app and try a new payment network, I'm going to pay the bill and get out of there with whatever method I'm carrying in my wallet. So, I mean, you can give me $10 to try it once, but that doesn't mean I'm going to do it the next time.
Yeah, I think you have strong network effects because there's kind of a many-to-many relationship, right? There's a lot of consumers shopping at many different merchants, and you need everything to kind of interact. And that's why Uber has strong network effects. You've got a lot of drivers that have kind of one transaction each with each customer, and that's why it's so valuable. I think it's the same thing here. But if there is a channel where you're going to the same place and you're transacting and making the same transaction regularly, that's an opportunity to disrupt that. So we see that with Starbucks. To what extent it's disrupting Visa or MasterCard, maybe not as much, but certainly that's a place where you can incorporate your own technology there, because you're a regular user, you're swiping your card every single time, and you're adding some value. Apparently you can order your latte ahead of time and have it be ready. So those are types of situations where maybe you have a vendor, maybe you're working with a contractor or someone where you have a regular transaction, you trust that person. That's a place that's kind of waiting to be disrupted, especially if there's current friction there with current payment providers.
Yeah, to your original point, there's going to be continued pressure, by regulators and large merchants on interchange around the world. We've seen it with Durbin. We certainly see it in Europe with the new regulation and other markets as well. So I think the banks and the networks, just see that as the way of life. But then we do think about what's happening in terms of some of the work that you guys are doing, plus tokenization. So as an example, if merchants get to take hundreds of millions of cards on file that are at risk of breach and replace it with tokens, and take the cost of that or the potential risk of that out of the system, is that worth something to them? Well, it probably is, right? If we can, and to the Starbucks app, it's a great one, because that's a business case study or a Visa case study where, so far, the cash that the Starbucks app is displacing is better for our network than the bundled, the fact that you're not paying every transaction, you're just paying for the load into the Starbucks wallet. So far, we just love the fact that we're displacing cash with the Starbucks app that we couldn't any other way, right? And so, there's going to be trade-offs along the way. We're going to find value-added services, but I think everyone in the ecosystem needs to get used to the fact that it's still highly competitive. Regulators are going to play their role, and we're going to have to adapt.
The other external factor on the traditional existing industry seems to be coming from digital currencies and blockchain. Is this something that is on the radar screen? Is this just noise on the edge, or does this seem like something that's going to have an impact? We've seen payment solutions for Bitcoin that are online, but what about Bitcoin or other digital currencies coming to the point of sale, bricks and mortar?
Yeah, so, I own Bitcoin in my Coinbase wallet, right? And so as a currency, I think Bitcoin is a long way from becoming a fiat currency. Volatility, regulatory uncertainty. It's a very complex thing. It's for a very sophisticated user. So for me, it's less about Bitcoin. That being said, Visa just announced an investment in a company called Chain, one of the startups that I would say is kind of coin or a blockchain network version 2, version 3, where forget the currency. What do these transparent algorithmic networks mean in terms of arguably connecting the Visa network to other tender types? A real estate contract, a securities deal, et cetera. So we're very interested in blockchain technology for what it does as a transparent global network. We don't spend that much time thinking about Bitcoin as a fiat or real broad-based consumer currency.
Yeah, I think from our standpoint, as an investor, we're still early in this evolution of Bitcoin and cryptocurrency. We're investors in Ripple, so we definitely have bets out on the space. We think it's going to be important, but it's still very early. I think, like you said, definitely more interested in the blockchain, although for everyone who understands Bitcoin, you know that you can't separate the two. You need the people transacting in Bitcoin. But we still, especially in the US, I don't think this is going to replace the payment networks, especially with the volatility. I mean, what would it be like if the price of milk, fluctuated in value every single day, because that's what's happening. Milk is priced in dollars, and right now it's not priced in Bitcoin. And that has serious implications for people transacting in it. But again, if you go outside of the U.S., you go to other places where there is volatility naturally, and there's friction and other issues with transacting, that becomes a much more viable alternative. It becomes a much more secure and safe way to transact. So definitely something that we'd be watching. Primarily, it's as a currency, probably outside of the U.S. first, and then maybe we see it come here. But right now, much more of a technology play on the blockchain.
Yeah, and I've always been skeptical on the applications of Bitcoin for real mainstream normal American consumers. I think the first time the light bulb came on for me, though, I was talking with the product manager of payments at Airbnb, and they have to pay out hosts in a lot of different countries. And he was basically like, look, I'm just trying to pay a host in Croatia when they had someone stay at their place. And apparently if there's a banking holiday in Germany, they can't pay a host out in Croatia because of how they route out their transborder payments globally. So the notion of getting funds from one country to another and paying people out with a lot of these marketplace businesses that expand into hundreds of countries quickly, I think that's a very real pain point. So using something like Bitcoin to do that outside of the traditional banking ecosystem, which does not have cost-effective ways of moving that money, that's an interesting problem, an interesting one to solve. Does that require Bitcoin to do it, or can there be other methods? You know, jury's out on that one. But so that's an interesting problem that I think can be solved. But I think for people paying for normal everyday retail purchases, like I'm not going to fill up my car and pay in Bitcoin at the pump anytime soon.
Let's turn this over to some questions from the audience. Right here.
Yeah, my question is, digital wallet is today internet dependent. Even in your mobile phone, you need to have internet, portable internet, then you can use it. And there are billions of people in the world who wants to use digital wallet, but they may be missing the bus just because they can't afford internet in their cell phones, or they don't access internet in their cell phones, basically in India and African countries and all. So when are we going to see digital wallets disintegrating from internet? They're becoming net neutral like.
I think they already are. I mean, so you can actually, I mean, part of the whole notion of a payment token is by making it something that's less volatile, less sensitive, you can actually store it in a phone, and it doesn't have to be in a, necessarily in a secure enclave, because you've said that this data is infinitely less valuable if breached, and therefore I don't have to invest as much in securing it. So you can actually have payment tokens stored in a phone that can be thrown off when you are offline, so the consumer phone doesn't have to have internet. Probably has to have battery power, but doesn't have to have internet. If you think of the original EMV technology, so these chip cards coming to the US, one of the origins of why it was developed was in Europe, doing online authorizations was very expensive because the cost of a local dial-up phone call would be 20, 30 cents when the European telcos were heavily regulated. So the whole technology was designed to actually facilitate payments when there was no internet connectivity available. So the original chip and pin infrastructure was designed to set floor limits and risk parameters that would allow a card to be presented and have the merchant accept payments up to a certain threshold without having to make a dial-up phone call. So you can use that same 1990s era paradigm and apply it to mobile payments in places with less connectivity.
It's not very exciting. There's no identity, but that's basically a Clipper card. But if you put your Clipper card on your phone, there's two ways to do it, with identity or without, but up to de minimis amounts, maybe without identity is okay. We don't live in a society, we may not be happy about Osama bin Laden, but we don't say you can't use the telephone and you can't go on the subway. We let anybody use a payphone, we let anybody basically buy, but up to a certain value. It really comes down to the risk limits.
I think also what we've seen, like in Kenya, right, is we see M-Pesa working without the internet with the participation of the carrier. It's a lot easier when one carrier has a monopoly in a country as opposed to a bunch of different carriers, in which case you need to get them to coordinate and talk to one another. Otherwise, the guy with Verizon can't pay the guy with the AT&T. So it's really about coordinating across all those carriers. And we've seen people try to do that in other countries as well. But I think that would be the play there, if you can't otherwise install an app and have apps communicate to one another.
Questions?
Yeah, according to the World Bank, last year, about $600 billion were sent by workers working abroad to their home countries. And on an average, they paid transaction fees of 6 to 8%. And they're trying to get that down. And when I looked into it, I found that a large number of people who sent the largest photo senders are Indians, and they sent back $72 billion last year. China comes next at 60. And the people who send this money back have cash, don't have bank accounts, and so the Western unions of the world really rake it in. And so the solution doesn't seem to be a technological one, even though people are trying to net out inflows and outflows. But this is a net inflow. There is very little outflow. So what are the solutions to this?
Yeah, we spend a lot of time focusing on this as part of our emerging market strategy, but also our unbanked strategy in the U.S. There are 55 or 60 million people in the United States that are unbanked. And so there's large remittance networks. About 8 years ago, we created a new transaction type in the Visa network called the OCT, the original credit transaction, which allows you to push money. Because if you think about the way payments works, for 55 years, a merchant pulled a balance from your card. It was a merchant-initiated transaction. We flipped that around 7 or 8 years ago, created the OCT, and today in Visa's network, any Visa card can send money to any Visa card. So we set up this service called Visa Direct along those corridors. We started in India and then United Arab Emirates. We're out of China right now, so we haven't focused on China. We've got now corridors in Central Europe, Eastern Europe, Middle East, and Asia where tens of millions of dollars a day are going phone to phone, Visa account to Visa account for an average of 35 to 50 cents a transaction, not 6 to 8% of the value, because the average value is about $200, so a person's paying $12 to $16. We're doing it for 50 cents. And so person-to-person payments, the whole area of push payments, that is a consumer who initiates a payment, a consumer who authenticates their own payments, we're just starting that. That's a new transaction type in the network, and we're going to see a ton of growth, and I think it will displace some of those traditional money sender models that we see today.
I also encourage you to look at a service like Halcash out of Spain. Halcash lets you essentially tokenize the transmission. So if you have a card or an account, you simply sends a text message to the other side, and that party in India can come to an ATM with nothing more than a code and can take money out of an ATM. So as long as you can find an ATM and that country participates in this program, you now have a way to have people receive money, remittances, even if they're not banked, even if they don't have a card. So we're beginning to see a whole spectrum of solutions.
I mean, the network effects in payments are really strong, and it's not just about credit card payments. And so the people that have widespread distribution of ways for people in a lot of places to load funds and ways for people in a lot of places to redeem them have really, really strong market power. And so they can charge rates that feel exorbitant because that happens to be the market clearing price. And so I think for that to come down, you need people that have strong network effects that are willing to come in at a lower cost, or regulatory pressure to push those downward, or small local communities that can achieve a smaller network that are going to come in at a lower cost. But there's a lot of, the entrenched incumbents have really, really powerful distribution networks, and that's why they're able to get away with charging what they are. Not that they should. I mean, it's not, I don't think it's good, but they do.
Just a quick one. As Bill mentioned, that the card that you're introducing does it report how many dollars was sent through it at the end of the year? Because that's one of the biggest reasons why people don't go to the bank not to pay.
No, yeah, so it's not a card. It's your Visa card today can send money to any Visa card today around the world.
Without reporting it to the bank.
No, all the AML, KYC, we see the transaction types. You get an electronic receipt. In fact, that's why governments are encouraging these electronic funds transfers, is because they want to bring some light to what is a very large gray economy in some of these markets. And so we work very closely with regulators and banks. So it's all recorded. It's very transparent. You get electronic receipts. Everybody knows what's happening.
So I'm curious, because I hear a lot of these doomsday scenarios. What if all the internet fails? What are the biggest risks that we're carrying, and how are we protected against this?
So what if the internet fails?
Yeah.
Yeah, I think we've got lots of other problems at the same time, right? That's probably not a question for us. I mean, transacting, I mean, it's a good point though, right? Like, we can always revert to cash, and as we move away from cash, do we remove kind of this fundamental ability to actually exchange goods and services? And do we lose that store of value that's so natural? I think that's a big question, and I think there's probably a lot of other immediate things that break down before we even lose that. But I don't know. I guess I'll be trading my jacket for a lift to, I don't know, the forest or somewhere where I have to run, because that's a pretty serious scenario, right?
And there's risk to everything. I mean, at the end of the day, it's all a risk management situation. I think it's, anytime someone says, you know, losing $1 to fraud is $1 too many. I mean, how many dollars are you willing to spend to not lose that $1 in the first place? So I think you've got to take a view. I think as far as the risks I'm willing to take, it's, you know, risk of internet outage or, yeah, table stakes.
Buy some gold.
I guess what I was asking is more, as you build the infrastructure to relying more on electronics, do you also build the risk reduction technologies to eventually, if there's a failure, back it up?
I think it's all getting decoupled. I mean, all of our infrastructure is built on Amazon Web Services, and I guarantee you our uptime is higher than any of our competitors that have old, like 1980s era .NET servers sitting in co-location facilities. And so we're focused on what we're really good at, and building distributed computing infrastructure is not a core competency of CardFlight. And so if anything, I actually see all these things becoming decoupled. It means you have counterparty risk, But like in our case, we have real-time redundancy. So our primary center is AWS East. We have a hot backup AWS West. So if all of Amazon's Virginia center goes down, America can't watch Netflix, but CardFlight can process a transaction. And so like we invest that kind of effort, but does that mean we don't own a single server? And we like that model.
So we'll take the last question.
Where do you see the market segmentation happening for the conversation about permissioned versus permissionless blockchains?
So I'll address it around two major themes that we think about at Visa. One is this whole loyalty coupons advertising model, because the networks have very valuable data sets that everyone would like to get to, and we think very carefully about them because we can't get it wrong, because there's a trust model that breaks maybe forever if we do. And so we think about, you know, double opt-in, re-opt-in every so often. Anything we think about in terms of our loyalty strategies is all around consumer control. The consumer's at the center of it. Everyone asks me in every panel around data and analytics, who owns the data? Well, you can argue whether it's the bank or the networks or the merchants. The customer owns the data. And if you start there, I think you'll end up in the right place in terms of loyalty and offers. The other thing we think about, though, is in terms of authentication. Like taking the friction out of payments because you've got to register your handprints or your eyeballs or your face or your vein structure. By definition, that's opt-in as well, right? And so we think about it in kind of two ways. Again, it's the consumer credential, however they want to represent the consumer. And I think most people who think about this space probably are adopting that consumer at the center of it.
I mean, I think in terms of private and public blockchains, I think right now you're going to see a lot of private blockchain adoption, especially from the banks who are kind of dipping their feet into this whole space. There's a lot of advantages to go to the public blockchain, of course. And I think that's kind of a more longer term evolution, but I think in the near term, it's much easier to sell someone on, hey, you and your 5 buddies are on the same network, don't worry, give this a shot. And then we could see potentially migration over to the public blockchain over time.